All right. Good morning, everybody. Good morning, all you magnificent melonheads of the world. Happy Thursday, everybody. Today's August 14th, 2025. And the top story this morning is the Producer Price Index, or the PPI. Yikes. Much, much higher than expected. To say that was a miss high would be an understatement. It was a miss way high. And you know, guys, I was watching metals run yesterday. Gold and silver had a good day yesterday. Bitcoin had a great day yesterday. Stocks hitting all-time highs. Everything was in euphoria mode. Everybody was like, yeah, here comes my Fed rate cuts. Easy money train, baby. Any idiot with a 0 DTE call option can make money in this market. It's so great. And then, well, that whole talking point, that whole diatribe, that whole monologue I had planned, crumple that up, throw it out the window, set it on fire, all that stuff, because PPI just came out and totally destroyed it. Now we're back to wondering, what's the Fed going to do? CME tool hasn't quite updated yet. The market hasn't had time to digest what this PPI report means. But yikes. All right, let's just talk about the numbers first, and then we'll get into the reasoning. The headline number year over year came in at 3.3%. That is versus market expectations of 2.5%. Right? That's not just a little miss, guys. It just blew away the expectations for PPI here. It's time to fire somebody else. Let's fire another stats guy. I don't know who we're going to replace him with. Let's remember those people who held up the binders. Remember that Epstein story with all those social media personalities, all those imbeciles and useful idiots who held up the Epstein binders, and it was really just information we already knew about, and they were just really just a bunch of tools who were being used for a photo op. Let's have them report the inflation statistics from now on. That's just an idea. Anyway, 3.3% versus 2.5% expected. Sharply higher than the 2.4% we got last month. A big jump here. Now, that's the year-over-year numbers. To really see what's going on with PPI, you got to look at the month-over-month numbers. That's when it really sets in just how big of a miss high this was. 0.9% inflation month-over-month for Producer Price Index. That is versus expectations of 0.2. All right, a slight miss there. We're only about 4.5 times higher than the market was expecting. And, of course, that is up rather sharply from nothing percent that we had in June. That is a big miss. And the core numbers, which strips out food and energy, well, they're just as bad. 3.7% year over year versus 2.9% expected, up from 2.6. 0.9% month over month for core inflation versus 0.2 expected. And again, up from nothing last month. Just an absolute whiff on PPI, much, much higher than the market was expecting. Guys, this is tariffs. All right, we saw that CPI report earlier this week, and the market was celebrating. Everybody was saying, well, maybe tariffs won't be inflationary. Maybe prices won't go higher. And then we got PPI, and it's like, oh, crap, so much for that idea. So we do know this is the first time anywhere that we have seen the tariffs start to be reflected in the economic data. Now, it doesn't really mean anything. We could go two ways here. We know stuff got more expensive because of tariffs now. The question is, what happens next? Do the producers take that higher cost and pass them on to the consumers? And of course, to find that out, we would have to wait until CPI next month. Now, typically, that's what producers do. When their costs go up, they raise their prices. The question is, can the consumers afford it? Will the consumers reject it? If the producers pass those prices on, maybe they don't sell as much stuff. So maybe the producers just eat the tariffs. They just eat the higher costs. Now, some categories that might be the case, but some of these numbers, like fresh fruit and vegetables, we'll give you that number in a second. Good God, they're not just going to eat that number. They can't. Their margins just aren't that high. So they're either going to raise prices or they're going to go out of business. And so the whole point of this market euphoria and this rally and everything that we saw earlier this week was meant to be like, hey, the Fed's bringing back the easy money. They're going to cut interest rates. They're going to juice the economy. Well, if the Fed has to worry about inflation coming back because of tariffs, then maybe they're going to slow that down. Maybe they won't cut in September, which up until this morning, it was a guarantee according to the CME's Fed Watch tool, it was like 98.9% likelihood that they were going to cut. And then there was like a 1% chance they were going to cut twice. I don't know what that's going to look like going forward. Now, there's not that much time between now and the September Fed meeting. So, look for a lot of jawboning from Fed officials. You're going to have some come out and say more data is needed. Some come out and say, I think we should cut. President Trump is going to want his cuts. There's nothing but questions today, guys. Nothing but questions on this. Now, some of the categories, the biggest increase was due to wholesale machinery. That category jumped by 3.8%. Now, that is a monthly jump. It was mostly in services and trade services within that category. Wholesale machinery was the biggest jump. Now, when I hear wholesale machinery in the context of trade, I'm thinking Germany. I'm thinking those tariffs on the European Union. They are showing up in the PPI here this morning. Will they be passed on to CPI? Great big question mark. That's what everybody's going to be debating and arguing and pontificating on Twitter about for the next few weeks. Another big category with a shocking number was fresh and dry vegetables. Holy shnikes. 38.9% increase in fresh and dry vegetables. That is a month-over-month number. What's 38.9% a month annualized? Don't answer that. It's really high. Look, I was really surprised by that number. I haven't had a chance to really dig into that. My initial gut, and me and Mish were talking this over before the call or before the live stream, probably Mexico, right? We import a lot of fresh fruits and vegetables from Mexico. Now, the avocados from Mexico, sorry, millennials, there's the avocado toast thing that they love hearing about. Just skip your avocado toast and you can afford a house, right? That's what Graham Stephan told us. Anyways, I don't know if this is the Mexico tariffs. The Mexico tariffs weren't that high, 38.9%. Maybe if you stack up the reciprocal tariffs and the fentanyl tariffs and the this tariff and that tariff, you get a tariff, you get a tariff. Maybe you get to a number that high. But then again, I thought agricultural products were exempted under the USMCA, the trade deal from Trump's last term. So that fresh and dry fruits and vegetables number really has me scratching my head. But holy crap, in the CPI report, we just got done talking about how food inflation was finally nothing last month. That was in the consumer price index. Well, food away from home, food at home, it's not going to stay flat if importers are paying 38.9% more for fresh and dry fruits and vegetables. So, guys, this is that tariff inflation showing up in the producers. It isn't hitting consumers yet. Will it? That's the question. Let me know in the comments where you think they're going to lie. Nobody really knows. We can all guess what might happen. This might happen, or the secondary effect, it might do this, or you might have deflation because it's going to result in demand destruction. It's just going to take a couple of months to see. And the point being, the reason why the market is reacting so strongly to this today is because nobody really knows, including the Fed governors who are going to decide whether or not to cut in September. And this whole big market rally is predicated on those cuts happening. So we got that going for us today. A couple other stories going on. China is deciding that they're going to order state-run firms to buy houses. Hey, what happens when nobody wants to buy houses and your real estate market's crashing? Just have the government buy the houses. Problem solved, right? I mean, who does that? And then we go look over at the mortgage-backed securities holdings at the Federal Reserve, and they're like, oh, that's right, we do that too. It doesn't really work out so well for us either. Also, a big lending slump in China this morning. Outstanding loans declined for the first time since 2005. Credit contraction, a deleveraging happening in China. Guys, China has a big deflation problem on their hands, as we're over here questioning about whether inflation will rear its ugly head again. China's got the opposite problem, and it is not going away. We also got some earnings this morning. Cisco narrowly beat expectations on demand for AI equipment. Also talking a lot about Project Stargate in their earnings. Interestingly enough, they have not yet received any orders from Project Stargate. Same as everybody involved in Project Stargate. They haven't done anything yet. They're just doing photo opportunities and talking points, which is pretty much what this whole mania is built on, but I digress. We got an interesting story about a trade delegation from India is heading to Russia next week to talk about trade in the rupee. That's an important one. Keep your eye on that. In the terms of geopolitical or geopolitics and the trade war and the BRICS countries, that is a very important story that I think we're going to hear more about next week. And we got a former Goldman and JP Morgan executive has been indicted because he stole a whole bunch of investor cash and gambled it away. Gotta love these Wall Street guys. They just cannot change their stripes. Guys, we got a lot to talk about once again this morning. How's about we shrink my big melon of a head and let's see what's going on in the markets this morning. Don't forget that like button and that subscribe button for the YouTube algorithm. And if you're new here, come on back tomorrow. Have your coffee with the melon heads because we do this every single morning. And, well, can you guys see on this chart where the producer price index release was? Raise your hand if you think you can see where it was. Look at this. PPI hits at 8:30 a.m. Eastern time, and down goes Frazier. Big drop in the market, all happening, coinciding. And with that report, everybody is resetting their expectations for the Fed rate cuts. That's what this means. Down 23 points, 0.36% lower ahead of the opening bell for the S&P 500. The Dow is not looking any better, off by 144 points, about a third of 1% down as well, all coming right after the PPI release. And the NASDAQ leading the way lower by 0.41%, off by 96, almost 97 points in the red. Stocks are down across the board because the easy money may not be coming back just as soon as anticipated. And we have got the opposite happening with the DXY. We have the dollar strengthening this morning. Again, a slightly less dovish Fed or a slightly more hawkish Fed means a slightly stronger dollar. And so we're seeing the dollar rally against other currencies here at 98.05 for the DXY. That's higher by 25 basis points this morning. And looking over at the bond market, we got yields are higher pretty much across the board here. 30-year treasuries at 4.829. That is higher by just a fraction of 1 point. The 10-year, meanwhile, is up by a point and change at 4.254. The 2-year at 3.716, higher by almost 3 points. And the 1 month is at 4.314, actually down by a fraction of a point, although I don't think it's going to stay there much longer. And then looking at the commodities board, metals are not liking this PPI. Again, prospects for lower interest rates is typically very good for precious metal prices, sends them higher because gold and silver compete with bonds for safe haven demand. And if interest rates are heading lower, that would mean gold and silver look more attractive. Well, the prospects of lower interest rates are being somewhat dashed this morning, and so metals are selling off, albeit a little bit, holding up pretty well here. Spot gold, $3,354. It's only down by a buck or 0.02%, not even a dollar here. So gold is holding up surprisingly well considering that PPI report. Silver, meanwhile, is down by 28 cents or about 0.75%, not doing quite as well as gold here. $38.22 for spot silver. But you know what? I still like the shiny. Copper is down by about 0.3%. Platinum is down 1.6%. Palladium is down 1.85%. I'm sorry, platinum and palladium are both up. I got the dyslexia thing going this morning. Platinum is up by 1.6. Palladium is up by 1.85. Sorry about that one. Crude oil higher by 1.25%, $63.44 for September WTI futures. All right, let's talk about crypto here because Bitcoin is just getting absolutely bludgeoned this morning. And I was ready to talk about what a wonderful, magnificent night Bitcoin had because overnight we hit a high, an all-time high of $124,533. Bitcoin was breaking out of its consolidation pattern, heading towards the 130s. And then we got that PPI report dashing hopes for Fed rate cuts. And Bitcoin has sold off like some $6,000 in the span of about an hour. I mean, this is really getting clobbered here. Hundreds of millions of dollars of levered bets are getting liquidated in crypto right now. Forced selling is happening. I tell you guys all the time, be careful on leverage when trading in crypto. This is why this volatility can wipe you out. Currently sitting at $118,863 is priced on Coinbase, lower by about $4,500 here. And since people were asking yesterday, we'll talk about Ethereum. Ethereum also getting clobbered here after having a very good night. Ethereum hit a high overnight of 4,792, now down to 4,549, off by about $200. Look, here's why I don't cover Ethereum that much. Let's just zoom way out on this chart. Let's go back to the last cycle. Guys, Ethereum was ripping last night. It went to about $4,700. It still has not taken out its previous all-time high from the last halving cycle. And so I have a hard time getting excited. This is one reason why I don't get excited about any of these altcoins. I don't get excited about Ethereum. I don't get excited about XRP. I don't get excited about Solana, because most of these coins, not all of them, but most of them still haven't taken out their highs from prior cycles. And then you've got these new players like Fartcoin and Goatcoin and all these other stupid things. Yeah, they're ripping like crazy, but you know what? Those coins are not going to survive the next winter. They won't come back and take out their previous highs during the next cycle. Until I see something consistently outperform Bitcoin across multiple halving cycles, I'm going to stick with pretty much just Bitcoin. I do own a little bit of Ethereum that I mined several years ago, and I'm just sitting on that. Maybe I'll trade it for Bitcoin, maybe not. For now, I'm just sitting on it. But Ethereum is selling off along with Bitcoin as well this morning. So let's talk about why it's selling off. Here is the actual report from the Bureau of Labor Statistics. EJ Antoni, you have your work cut out for you if you got to polish this turd this morning, because it's just not looking so good. The producer price index for final demand rose 0.9% in July, seasonally adjusted. Final demand prices were unchanged in June and moved up by 0.4% in May, meaning all of a sudden we have got a big inflationary shock hitting producers this month, or a hit in July. Let's talk about where it came from. 30% of the July rise in prices for final demand services can be traced to margins for machinery and equipment wholesaling, which jumped by 3.8%. And that is your European tariffs. We buy a lot of heavy equipment and manufacturing equipment from the Germans. Europe got hit with those tariffs, and so higher prices there. The indexes for portfolio management, securities brokerage, dealing, investment advice, and related services, travel accommodation, automobile retailing, and truck transportation of freight also advanced. In contrast, prices for hospital outpatient care fell. The index for furniture retailing and pipeline transportation of energy products also declined. So it looks like wholesale machinery and equipment wholesaling was the big jump there in the services category. Now, within the final demand for goods category, a quarter of the July advance in the index for final demand goods can be traced to prices for fresh and dried vegetables, which jumped 38.9%. Yikes. That is a big, big increase there. Why fresh and dry fruits and vegetables? I don't know what's hitting that so hard. It's got to have something to do with Mexico. But again, I thought ag products were exempt. We'll have more time to digest those numbers in the days ahead. But look, guys, here's your chart of PPI. This is your headline year-over-year number. It looked like PPI was trending in the right direction right up until June, when we were at 2.4%. And then, the market was expecting just 2.5%, and instead we got 3.3%. So just a big shock here. Now, the month-over-month number, this is what really worries people. Now, here we're going all the way back to 2021. You can see there's your 0.9% after coming in at nothing last month. And that 0.9 is the highest read we have had since March of 2022, when we were at 1.7%. And remember, March of 2022, that is when the Fed first began its tightening cycle. So this is the highest PPI we've seen since the last time inflation was really, really bad. The numbers in core pretty much the same. Big jump to 3.7% year over year from 2.6% year over year. And then on the core numbers monthly, a big jump to 0.9% from 0.0. Guys, this is just a big miss on PPI. And again, everybody's got to adjust their expectations. Let's check in with the CME and the Fed watch tool here. Let's see if this has adapted now. We were like 99% certainty of a cut in September. And now, okay, it's adjusting now. Now we're at 94.5% certainty of a cut and a 5% chance that they do nothing. This market is stubbornly dead set that this September cut is going to happen. Now, look, PPI is not the most influential of statistics. It doesn't matter as much as PPE, the producer, PCE, the personal consumption expenditures. That's the Fed's preferred measure of inflation. And CPI is more important. And the jobs number is more important, right? In the grand scheme of things, PPI is not the most important statistic. But PPI tends to front run CPI. And that's why it's important, because this means one of those other very important statistics may be about to head higher. And the Fed certainly doesn't want to cut rates 2 days before CPI comes in shockingly high. Then they're going to have even more mud on their face. So, It's the Fed is in a tight spot here. They don't really know what to do. Again, the market is still, in my opinion, being very optimistic about this 94% likelihood of a rate cut in September. I mean, maybe I'm just way off base here, but I would think at the very least, there's a 20% chance that the Fed doesn't move in September now. Market only says 5. Meanwhile, we got a couple of stories coming out of China this morning. This is interesting. China malls asking firms run by central government to buy homes. All right, what do you do when your housing market is crashing? Just have the government buy all the houses. What's the worst thing that could happen? Don't answer that. China is preparing to mobilize companies owned by the central government in Beijing to purchase unsold homes from distressed property developers following the limited success of a previous initiative that relied on local governments, according to people familiar with the matter. So we reported on this local government story. This was like last year, almost a year ago. China ordered the local governments to buy up all the properties from the distressed lenders. But at the same time, the local governments didn't have any money because the local governments get all of their income from those distressed developers and land sales to them. And so the local government didn't have any money to buy those houses with, even though the central government ordered them to do it. Also, while the central government was ordering the local governments to get their debt problems under control, somewhat contradictory orders there. So very predictably, that didn't work. And now the central government is just saying, okay, since the local governments won't do it, state-owned enterprises, you guys do it. Regulators are planning to ask some of the biggest state-owned enterprises and bad debt managers, including China's Cinda Asset Management, to help clear the housing glut, said the people asking not to be identified because they don't want to disappear in the middle of the night. The firms will be allowed to tap 300 billion yuan, that's about $41.8 billion, worth of funding that the central bank earmarked for the program last year, one of the people said. The renewed effort, which is still under discussion, could help speed up the clearance of China's 408 million square meters of excess inventory. That's larger than the size of Detroit, and ease the financial burden of the troubled developers. Officials are also considering scrapping a price cap for the program in a bid to accelerate the process and improve the economics of the plan for both developers and state buyers, people familiar said in March. And look, government's buying up houses in order to juice the housing market. I mean, who does that shit? Am I right? Oh, yeah, about that. This is the chart of mortgage-backed securities held by the Federal Reserve. And, well, the Federal Reserve owns $2.120672 trillion worth of mortgage-backed securities. So, yeah, the government doesn't just buy the houses here in the States, but we have our central bank, which is kind of government, kind of not government. We have them buy all of the debt that is inflating the home prices here in the States. And you might be sitting there saying to yourself, well, Jack, that's pretty much the same freaking thing, isn't it? Yes. Yes, it is, as a matter of fact. And it does not work well for us here either. Maybe governments should just get the hell out of the housing business entirely. Let people buy and sell houses, not governments and central banks. Hey, I just throw them out there. You guys do what you want with them. We got one more story out of China this morning. China's rare lending slump feeds worry about slower economic growth. China's got themselves a deflation problem going on here. China's first contraction in outstanding loans since 2005 has crystallized worries about a deepening downturn for the world's second largest economy. Instead of putting money to work, households and companies are paying down their debt as they take a more dim view of their prospects, threatening a self-fulfilling cycle of economic underperformance. The longest deflation streak since at least the 1990s is also suppressing demand for borrowing, contributing last month to a 430 billion yuan, or about $60 billion decline in loans to the real economy, the most on record going back to 2002. Weaker loan demand tends to be a negative sign for future growth, said Lin Song, chief Greater China economist at ING Bank. My biggest concern is the entrenched pessimism, which is the main reason for weak consumer and corporate borrowing appetite. You guys who've been following the channel for a couple of years may recall my big worry back when I was doing all those videos about the Evergrande collapse. I kept mentioning the wealth effect and how people's consumption patterns, the amount of money they spend, is directly proportional to what the value of their home is doing. It's much more impacted by home values than it is things like stock values. When we see home prices decline, people spend less money. It's not as pronounced when stocks go down or other investments go down. But when the home goes down, people feel less wealthy and they spend less money. And here in the States, that's a very big problem where the average person has about a third of his net worth in real estate. Well, in China, the average person has about 90% of his net worth in real estate, which means the wealth effect is even more pronounced in China. And, well, China's in the middle of a housing collapse, and so consumption is slowing. Debt is going bad. People aren't spending. People aren't borrowing. The economy is deflating. Oh, and while that's going on, the population is collapsing, so there's fewer people to buy the goods and buy the homes and live in them. China is at the beginning of a multi-decade deflationary spiral. There's no easy way out of that. And unless the Chinese suddenly start drinking and listening to Barry White, I don't know how they're going to reverse the trend of population decline. Something better change over there fast, though. Back on the domestic front this morning, we've got Cisco reports a narrow earnings beat and issues an inline forecast for the year. We're just about done with earnings season here, but Cisco reported today. They reported results that narrowly exceeded analysts' expectations, issued quarterly guidance that was also better than expected. Earnings per share were 99 cents. That's beating by a penny the expectations for 98 cents. Revenue of $14.67 billion beat expectations for $14.62 billion. During the quarter, Cisco said it would collaborate with a partnership to invest in artificial intelligence infrastructure alongside BlackRock, Microsoft, and other companies. It joined a Stargate data center initiative for the Middle East that involves OpenAI and SoftBank, and the company introduced switches and routers that can take on AI workloads. Cisco is in the planning phase of sovereign infrastructure projects, CEO Chuck Robbins said on the call. We have not taken any orders from them yet, he said. We've been in the planning phases with them. They're obviously working through getting the licenses for the GPUs. That matches some articles we saw last week about how Stargate, even though they claimed they had $100 billion they were going to spend right away back in January, they have still not spent one single penny of any of that money. It was just a stupid publicity stunt. And here we are months later, they're still not doing anything. AI infrastructure orders from web companies in the quarter reached $800 million, Robbins said. The total for 2025 fiscal year was over $2 billion, more than double the company's goal. About $1 billion of those orders from the fiscal year were earmarked for back-end networks that connect GPUs, Robbins said. So Cisco's seeing a little bit of money from the AI bubble, not a whole lot, not enough to move the stock this morning. That one is down 1.14% ahead of the opening bell, trading at $69.47. Actually, the opening bell just rang. Let's see what we got. 68.44, down 2.6% now. So it looks like that 1 penny earnings beat, not enough to move the needle for Cisco. Meanwhile, this is a story to pay attention to. This one could move markets in the future. Indian delegation to discuss rupee trade in Russia next week. Rupee-denominated trade will be among discussion topics when a high-level delegation visits Russia next week, an Indian official told reporters. Another sign that the South Asian nation is deepening ties with BRICS partners after U.S. President Trump's punitive tariffs. The Indian team will visit Moscow on August 20th and 21st, the official said in New Delhi Thursday, asking not to be identified. India will also discuss a free trade agreement with Eurasian Economic Union countries during the visit, the official said. So this is important in the context of the trade war, of the secondary tariffs on India, of the war in Ukraine. By the way, President Trump is meeting with President Putin tomorrow in Alaska to discuss ending the war. Please, you guys, let's not have our egos get in the way, resulting in the deaths of tens or maybe even hundreds of thousands of people. If you guys could just have a good meeting, we'd sure appreciate that. But this Indian delegation going to Russia, you see, India has been buying this cheap Russian oil, which is why President Trump recently doubled the tariffs on India. The rest of the world said, no, we want to punish Russia for the invasion of Ukraine. Nobody's allowed to buy the oil. India said, no problem. We'll buy it on the cheap. We don't have a horse in this Ukraine race, so we don't care. And now we are punishing the Indians for that. Now, the Indians, as they've been buying this Russian oil, they have been paying in their local currency, the rupee. The problem is India doesn't sell anything to the Russians. So after several years of this, Russia is sitting on this massive pile of Indian rupees they have nothing to do with. They don't import anything from India, so they can't spend the rupees back into India. The only option they have is either sit on it or they could sell those rupees for gold or for their own currency. But of course, if they do that, it's going to crash the value of the rupee, and they'd be lighting their own money on fire, devaluing what they're being paid in oil for. So this is why having a world reserve currency can be pretty important to keep trade balanced. And so that will be a hot topic during this meeting. Russia's going to insist that they start paying in rubles. India is going to say no. And I'm sure all you BRICS guys are there. I get this comment all the time. Oh, the gold-backed BRICS currency any day now. Guys, we've been hearing about that for years, and we're no closer than we were in 2022. And I got my side eye over here. I'm looking over at Bitcoin. I'm saying, Russia, if you're worried about all these, accumulated rupees, why not have the Indians buy Bitcoin with their rupees and then pay you for your oil in Bitcoin, and then you can do whatever you want with your Bitcoin. The IMF can't sanction it. They can't do anything with it. It's basically untraceable money, or it's not untraceable, but they can't control it. Or you could settle it in gold. It's a little more cumbersome, but that's another way to do it. Either way, if they can't transact in dollars, they have to transact in something else. And as always, that is easier said than done. Meanwhile, we got a former Goldman Sachs, JP Morgan exec gambled investor funds, according to the DOJ. I guess the first clue that this guy might have been up to something was the fact that he was a former Goldman Sachs and JP Morgan executive. Shocking that he would be a fraud. A former Goldman Sachs and JP Morgan executive has been indicted for allegedly gambling away investor funds, according to prosecutors. Richard Kim, a former Goldman Sachs and JP Morgan Chase executive, was indicted on securities and wire fraud charges related to his alleged misappropriation of about $4 million in investor funds for his startup online casino company. Kim recently joined crypto merchant bank Galaxy Digital as its new COO. Pay attention, guys. There's more fraud in the crypto space. I'm telling you, we are close to crypto winter. However, he then left it to found Zero Edge, which Galaxy then invested in, not Zero Hedge, mind you, Zero Edge. As alleged, Richard Kim misled investors by promising that he would build a blockchain-based casino gaming app, but ironically, Kim turned around and gambled away the very funds he said he would use to build the better casino. That's according to U.S. Attorney Jay Clayton. Founders who abuse the trust of their investors threaten the integrity of our important and uniquely American venture capital market. Apparently, after obtaining the investor funds, Kim misappropriated them by transferring them to personal accounts where he made leveraged cryptocurrency trades and gambled away substantially all of the company's money. Well, that's good, clean fun. A former bank executive gets into crypto gambling and loses a bunch of other people's money. Well, come to think of it, this sounds like every other story I've read about bankers and crypto over the last few years, but I digress. All right, guys, last but not least for the day, we also got jobless data today, and it's more of the same. Initial jobless claims down from last week, 224,000 initial jobless claims. The pace of layoffs still not that bad. I know we're seeing a lot of anecdotes out there about big tech laying people off. Those have been there for several months now, but it's still not showing in the initial jobless claims data. Maybe we should fire another statistics guy. I don't know. But it's not showing there. But the weakness in the labor market is continuing to show in the continuing jobless claims. Continuing jobless claims for the week ended August 2nd were 1,950,000 or 1.95 million. That is down slightly from the new high we hit last week of 1.97 million, but still elevated, higher than we've been for the last couple of years. Again, people who lose their jobs are having a hell of a time finding a new one. Again, not necessarily screaming weakness in the labor market, but not exactly the strength in the labor market that our central bankers have been advertising for the last several years either. And I just want to say thank you very much to M&J, who has said, how could we miss Janet Yellen's birthday? Is it really Janet Yellen's birthday? Is it really? By the way, Janet Yellen rumored to be, what was the story yesterday? So many people sent me this message yesterday that Trump was actually considering Janet Yellen as the next Fed chair. Well, of course, they were considering me as the next Fed chair, Jack. I am the greatest Fed chair that ever was. I tell you, I am so good at chairing Federal Reserves. I should walk out with a big gold belt around my waist like the Macho Man Randy Savage. Oh, yeah, that's me, your Fed governor, Janet Yellen. And by the way, happy birthday to me. Is it really your birthday, Janet? Is it really your birthday? When you're a central bank governor and you can print your own money, every day is your birthday. Well, thank you, Janet. As always, your honesty and she just opens up here on this channel. She doesn't do that anywhere else. We get a good glimpse in the inner workings of the mind of Janet Yellen here on this channel, and she never disappoints. Thank you, M&J, for being a Melonhead member for 18 months, a year and a half veteran of the Melonheads. And thank you, Charles G., who says Scott Besson said Trump is considering Janet Yellen also for the Fed chair. See also earlier comments. What will you do when you're back at the Fed? Are you guys making me use my Janet twice today? 2 Janets. Charles, I already told you, I am master and commander of this ship. You give me controls of that money printer once again, and I will print money like the blazes. I am the greatest. There has never been anyone like me at the helm of the printer. I know my successor, Jerome, actually printed more money when he was in charge at the Fed, but he had to because I was spending more money than anyone in history when I was at the Treasury. And you might be wondering, hey, aren't we supposed to have a gap between the Federal Reserve and the Treasury? Well, my greatest achievement as central banker and Treasury Secretary was blurring that line to the point where nobody can even see where it is. Well, there you go, Chuck. You made me dust off my Janet a second time today. There we go. Janet Yellen. I heard that story yesterday, and Mish brought that up on the call yesterday. He says, oh, yeah, I heard Besson said they were considering Janet Yellen for Fed chair. And I said, my first thing I just said was, no, they weren't. No way. No freaking way, right? They wouldn't. And then I thought, well, yeah, maybe they would. You know, when you look at what they did with tariffs and the big, beautiful bill and the Epstein story, let's be honest. President Trump could put Janet Yellen back in charge of the Federal Reserve, and it would only be like the 3rd or 4th worst thing he's done this week. What the hell is going on? Now, you guys remember before the election when I said it doesn't matter? Remember what I said? Whoever they elect, they're just going to print more money and lower interest rates. It doesn't matter who. Remember that? I mean, I voted the way I voted, but you remember I said that. Well, here we are. And that's what he's doing. All right. There was this token effort to cut spending in January. We called it Doge. Really, all it was Elon Musk's market cap going up in flames. They didn't actually, what did they cut? $11 billion? A freaking rounding error. That's enough to fund the government for about 11 minutes. Yeah. They're going to print, they're going to spend. And that's probably why everything was ripping. I mean, look, we got this PPI data this morning, and now everybody's starting to wonder, maybe they won't cut. I don't know. Will that PPI story really be front and center in central bankers' minds when they get together in a couple of weeks? Probably not. By then, we'll have some other data, or by then, you know, President Trump will have appointed, I don't know, Roseanne Barr to be the chairman of the Federal Reserve, the next shadow chair. She casts a large shadow. Why not? I don't know, guys. Either way, the easy money, we all know it's coming back sooner or later. The government, the central bankers, they're a one-trick pony. And Pigo is back. He says, we got to do a leather Yellen episode. A leather Yellen? You're scaring me, man. Janet Yellen in leather. Yeah, there's a visual. Sorry, man. I apologize for the visuals. Pigo sent me a DM. I will check the DMs. Thank you, brother. You're not going to get a third Yellen out of me today. Sorry, guys. We're just the market for Yellen is saturated this morning. But I do want to say thank you so much, everybody, for your support of the channel. Thank you for watching. Don't forget that like button and that subscribe button on the way out. Oh, come on, Pigo. He's back. He's saying, do Mushroom Yellen upstaging Jerome with Q. Sorry, Yellen's not tripping balls this morning, Pigo. I'll check your DMs, though, brother. Thank you for supporting the channel. Hey, thank you also to my Patreon supporters and magnanimous Melonhead members here on YouTube. Links down below to all that good stuff, should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big. Janet's on mushrooms again.